Hey, what's up, people? How y'all doing? Let me cut this down. It was loud last time. Well, let's see what these people talking about today, right? Let's see what they talking about today. Wow. What's up, fam? How you doing? How you doing, family? Dollar cost average. It's, you know, it's one of those things where you're going to get tired of hearing it, but I'm trying to not get in trouble and just let you guys hear the meeting. Good afternoon. Good afternoon, good people. Good afternoon. Hey, how you doing? What's up? What's up? How you doing? Yep. How are you? How are you? All right. As we could see, wow, the Dow is up. S&P is up. They're all expecting good news. Everybody's expecting the Fed to be dovish and not hawkish. Yep. What's up? Can I get a hey? Man, that dude with that hey-oh, he drives me crazy. Hey, how you doing? Yeah, the market is looking upwards, but we have to be careful. All right? Money makers. That's it. That's it. What's up, family? Okay, we're just gonna, let me see if I can delay this. If I delay it, I believe I won't get in trouble. Let's see. Just gonna delay what they say by a few minutes. Hey, blessings. Blessings, family. Blessings, family. Let me bring this up. Also on my, hey. Let's see what the Fed say. Yeah, let's see what the Fed say. Right. Let's go, Darius. Let's see what the Fed is talking about. I guess I'd have to pull it up on my phone. Okay, I'm gonna try to bring it up a little bit. Let's just listen for a minute.
Not buying anything, and they haven't shrunk anything, okay? So basically, they're putting the market through this ordeal for months and months and months, generating all this volatility. They should stop buying, they should slowly start raising, and they should do it rather quickly. They're not going to do that. If you want me to comment on what the Fed is saying, I basically think that they're not necessarily taking the route that I or many people that trade the markets would take. They're going it alone. But I would say one thing, quantitative tightening or the lack of quantitative easing or shrinking the balance sheet most likely will be the most painful. Because if the economy can't stand going from 0.25 to 1 to 1.25 by year end, there's a whole lot more wrong with the economy than the fleeting effects of Omicron.
And there's the 10-year above 1.8% there. So let me turn to Jim Karen. Jim, just as you said, the Fed will likely signal a rate hike in March, and indeed they basically have. But you said more important is any hint or signal on the balance sheet operation. So what do you make of this so far?
So thank you for having me on your show, Kelly. Look, I think this is a clear lack of clarity, and it's probably by design from.
So yeah, the Fed is going to be talking a little later. This is going to be I'm in this. I started to come on when he starts to talk, but I just wanted to be up, make sure there was no problems. So I'm just going to hang with y'all for a minute, if y'all don't mind. I'm just hang with y'all, right? I'm going to hang with Mark. I'm going to hang with Maurice. I'm just hanging with my family, man. We're going to see what this is all about so we can know what we going to do, right? We gonna do what the market is telling us to do and not based on our previous plan or what we feel. Telling you, you can trade off of what you feel and the market is gonna make a stone fool out of you if you just I feel this. The market don't care about how you feel. It just don't. So we have to be ready to move when the market moves. What's up, family? How you doing? Yep. So yeah, you guys, if you're at work or whatever, you want to come back in 30 minutes, you can. But I'm just gonna stay live, until I just wanted to be in early, and then we can discuss what's going on. Yep. What's up, Black Santa Claus? Where is that at? Hey, what's up? How you guys doing? You know what? I love you guys, man. I really do. You guys have no idea how much time that is dedicated to this. Really, I literally have no life. I go to bed, I wake up, I give God his time, and I give my wife her time, and sometimes I share her time with you guys. So for those of you that are looking to do this, man, my hat's off to you. It is 8 days a week, like the song says, 24/7, never off. But I just realize and I understand how much money's going to be made doing this. I just really realize, thank you, Alvin. I just really realize that, AKA from the streets to Wall Streets. I love that. I love that. From the streets to Wall Street. That sounds like a Wall Street Trapper, my brother Wall Street Trapper out there doing some, man, I love that. I love what he's doing for minorities, man. I love what these guys doing. Listen, we got to understand that there's a lot of areas to be covered, right? Some people, hey, Pakistan, there's checking in from Mississippi. Hey, what's up? Felix, my people are from Jackson and Canton, Mississippi. What you know about Mississippi? Crooked letter. What you know about that? All right. Hey, so we got to understand, we got to understand that there's a lot of areas of people that need to be helped financially, right? And we're all reaching different people, right? And so, I love what they're doing over there at EYL, Earn Your Leisure. You guys heard me bring that up. I love what Wall Street Trapper. I'm going to have Trapper on the show. I'm going to have Ian on the show. I love what those guys are doing because they're bringing this information to minorities, okay? And that's their call. We have to understand we are all working together. You guys are my call. The average guy across the world. My call is everybody, all ages, all races. It doesn't matter. That's my call. My call is to bring this information to people who don't normally have this information or don't understand it. I try to demystify all of this language and break it down so you can understand. Though, I have millionaires following me, but I know that that's not 100% of my market. And so I try to bring everybody along. So, there's going to be some times when you guys don't understand the moves right away, but then down the road, you'll understand the moves. Like, last year, you heard me, I was number one, buy the dip, buy the dip, buy the dip, buy the dip. But in December, everything changed because I saw this coming. This bear market coming, right? Because of the rate hikes, right? So now I've been saying, wait. And, the Dow has dropped 68% since I've been telling you guys to wait. So I've been hoping to save you guys money as the market keeps ratcheting down and down and down and down. So I've just been saying, wait, cash up. So now we are in a better position to buy. Even if you start buying right now, you are in a better position than people who've been buying the rest of this month because stocks are just down. Even with the run up today, you're still good. And so that's what I was trying to do, good people. And, sometimes, we got to know when to hold them, know when to fold them, know when to walk away, and know when to run, right? And it changes, good people, from day to day. Truckers, my truckers, what's up? I hope, hey, be safe out there, right? Hey, love you, fam. I love you, fam. Yep. So, but that's what's up. Yep. Bull run on crypto. All I will say is I would rather it bottom out and then start to go up, right? And then we find out that we bottomed out, right? Rather than we think this is the bottom, even with crypto, and then we have a slight rebound, and then it goes down even further. No one knows. No one knows. So you enter in at your own, enter in where you think it is, right? Remember, I have to tell you guys constantly, anything I say is not, NOT, not a suggestion for you to buy, hold, or sell a stock or a crypto. Okay? I have to do what I believe is good for me. You have to do what you believe is good for you. All right? Nice shirt. Thanks, fam. A billionaire can't give every American $1 million. I don't understand that. Yeah, we are going to heaven. I hope so, brother. That's what this is all about. I'm not going to do that. I had somebody walk up to me and offer me $300,000. And I said, there is no way. Number one, you got to be licensed to do that. And number two, I'm not going to have people calling me every 5 minutes. Hey, man, I need about $10. Oh, wow. Yep. Yes, please, good people. I can't even see how many people are watching at this time. Let me see. But hit that like button. 600 people. Hit that like button. I know, a lot of you guys are at work. Some of you guys are at work in the washroom. Like, let me check this out because you got, this is your money, man. Well, hey, the Fed is going to be talking in about 15 minutes. So let's talk about, man. Y'all, please hit that like button. Hit the like button. Like that money mellow. So listen, let me do this right quick. So I was thinking about this for those of you that didn't see this yesterday. Hey, let me tell you something about this family, right? I I absolutely love the fact that we are from all across the world, okay? Hey, if you're from another country, we'll get in the States, but if you're from another country, go ahead and post where you're from. Everybody from other countries outside of the United States, and even if you're in Hawaii, I know Hawaii is part of the U.S., but hey, you're across the water, okay? Post where you're from. Appreciate you. Wow, New Zealand. New Zealand is in the house. South Africa. South Africa is in the house. Canada is in the house. Is this the UK? Oh, we're from everywhere. Look at this. Haiti. Haiti is in the house. Look at that. Colombia in the house. London. We got London in the house. Look at all of these countries, man. This is what I love, man. We're family. We're family. Switzerland in the house. Man, I'm going to be doing some heavy traveling over the next couple of years. Pakistan in the house, man. Man, I had some Pakistani food the other day. I can't even tell you what it was, man. It was delicious. Well, when the other day, it was last year. But it was delicious, man. Pakistan in the house. London in the house. Yes. Yup, we got Canada already. Yup. Singapore in the house. Bro, you look scary over there. I'm scared of you. U.S. in the house. Australia in the house. Yup. Canada, Sweden. Hey, I love it. Jamaica. Come on, Jamaica. The Netherlands. I said Netherlands. I swear, I swear I jacked some words up. Iceland is in the house. Oh man, I love it. I love it. Netherlands again. Macedonia. Wow. Man, I'm telling you guys, I want to get back to Ireland. I went to Ireland with my friend Christian. Woo! I want to get back to Ireland. All right, let's some Spain is in the house. All right, what state are you from? And then we're going to get into some stuff. We're just killing time until they talk. Germany is in the house. All right, now we got Kuwait. Kuwait is in the house. All right. Man, y'all stay cool in Kuwait, man. Man, the deserts. I talked to some army personnel that spent some time in Kuwait, man. And we're talking about those dust storms. Woo! He was showing me some pictures. Miami in the house. Portugal in the house. Look at this. Ukraine, woo, what y'all gonna do, man? This seriously, man, we praying for you guys in Ukraine. That Russia-Ukraine situation is no joke, man. So we praying for you guys. We praying for peace and stability. There's a time to fight and there's a time to bag off. And so I hope that situation goes away with no casualties, okay? Look at that. Toronto, UK. Yep, we got Portugal. All right. So, hey, Northern Canada. See, there's a difference. I got a friend from Canada. He's a pastor here, Todd Matchett. So he would know the Northern Canada. I can't even say the other words. I'll butcher that up so bad. Yep. So, hey, how much time we got? About 20 minutes. So check this out. Check this out, fam. This is what we're going to do right now. How far you think Shiba Inu will go? I don't know, man. I really don't know. India. Yep. Hey, aloha. God bless you too. God bless you. God bless all of us, man. This is what's happening. All right. Dubai. I am absolutely going to Dubai. Afghanistan. Nigeria. My Nigerian brothers too. My Afghanistanian brother. Look at this. Man, Africa is in the house, man. Uganda. Iraq. Okay, so let's have a little fun. We got 10 minutes left, about 12 minutes left. Hey, listen. We are all God's children, right? We all God's children. Somebody said, why do you call them family? Because y'all are family to me. And I've never seen you. We've never been in the same house. A lot of us, as you can see, never been in the same country. But we all family. We got the same father, right? And I did this before. I'm gonna do this again. So you guys know that my friends Stockmo and all these other YouTubers, they're my friends. We haven't been in the same room, but I talk with Stockmo. That's my brother. That's my YouTube brother, and Keenan Grace. That's my YouTube brother. So listen, after we do what we need to do in this market, which was buy these dips, okay, and start dollar cost averaging in, is what I'm saying. Dollar cost averaging in. I said buy these dips, but I mean dollar cost average, because some of y'all gonna get uptight, all right? Then there will be time to dip buy, okay? Let's just listen to what the Fed says first before we make a solid plan. He could say a gamut of things. He could say, I'm doing a 2% rate hike today. That'll crash the market immediately, and then the recovery will be quicker. Or he could say, I'm doing 5 rate hikes this year, and it'll still have a negative effect, but over a longer period of time. All right. And so that's what we have to understand. We got to listen. But when this is over, all y'all going to church with me. All y'all going to church with me all over the world. We going to church. So this is what's going to happen. I'm going to challenge Keenan Grace, and I'm going to challenge Stock Mo to go to church with me. And not just go to church with me, they're going to dance. After we all make some money, we got to celebrate, all right? And so this is what I'm going to do, right? So let's see. This will be Keenan Grace because he young and he cool, right? So this will be Keenan Grace. Let me see if I can play this. So this will be Keenan. You see him getting down? That's going to be Keenan Grace, right? But this will be Stock Mo. This will be Stock Mo right here.
Listen, all of you that dance straight on, you missed the miracle because you didn't take advantage of the opportunity. So when you
I had the other track playing. Let me stop that. So that'll be Stock Mo. We're gonna hold Stock Mo to that, right? Let me show y'all some more Stock Mo. We got time. This will be Stock Mo. And then I'm just going to I'm going to just go for it. I'm old school, so I'm like from the 70s, break dance. This is going to be me. That's going to be me, good people. I'm going to be like, hey, you just got to do what you can do. All right, good people. So, I'm just killing a little time because the Fed is coming in. We got just 8 minutes left. All right. And then I'm going to just shut up and let it go. But hey, that's what we going to do. We all going to dance. We going to party. We going to all go to church. And we're going to have a good time, man. We're going to give thanks, all right? And so that's what we're going to do. But I will tell you guys, in all due seriousness, this is what I'm going to say about what's happening right now and where I believe, hey, God bless you too. So this is what I believe that it's time to do. And I know this is a bold move, and I've been posting this sorry. I know this is a bold move, but this is what we need to be doing. I'm telling you guys right now, if the market tanks, be positive, be strategic. I got some COGIC, some Kojic folk in the house. Yep. So, that's my roots. So this is what I'm going to say. This is what I love that I saw, and I'm going to keep showing this, okay? Listen, look at this. This person said, I posted this a couple of times, but I still want you guys to see this. This gentleman, Augusto, said he don't have enough funds, okay, because the dips have been dropping. Again, I'm going to keep posting this because Dan Morgan, man, bless you. He said, I started driving Uber, just look for a part-time job somewhere. And the reason I like that is that they're trying to do something about their future. When you see an opportunity to buy stuff at a discount, then do something different if you want to get out of your situation. Don't just do the same thing. right? If you've been struggling financially, if you just struggled the rest of this year, good people, and I don't mean struggle like, I mean get ready to invest your tax returns, okay? I mean, don't buy the $350 Nike shoes. Buy Nike for the rest of this year. I mean, don't buy the new iPhone. Buy Apple for the rest of this year. That's what I'm saying. All right. We got 5 minutes. All right. See here, we got 5 minutes. All right. And so change what you're going to do this year. All right. Because this is an opportunity to change the entire forecast for the rest of your life. This is my message that I'm preaching to you today. All right. Can I get an amen from across the world? Can I get people in other countries just to give me an amen? Because this is what we need to be doing right now. Because if you truly want to, yes, sir, 5 minutes. If you truly want to build generational wealth, then we have to change what we doing. We got to reposition ourselves. And for somebody told me the other day, and you guys know I say this all the time. Somebody told me the other day, yeah, but you know, the good book says the poor will be with you always. And I just looked him in the eye and shook my head. And I said, yes, but not you. That's not for you. And I'm going to look you in the eye and tell you, you struggling to pay your bills is not for you. It's not what your creator have for you. He didn't create you. That's why you're here. You have to understand the simple reason that you're here watching is an opportunity that a lot don't have. Knowledge. This knowledge is going to help you change your life financially. It literally can change your life financially. I guarantee you, if you do some long-term investing, there will be a season where you will be going to work and your investments will be making more money weekly, monthly, yearly than you going to your job through long-term investing. And that's when you have emancipated yourself through building wealth. We're not trying to be rich. We want to be wealthy. We're not trying to get enough money for just ourselves. We want enough money for our children and our children's children. The good book says a wise man leaves an inheritance for his children and his children's children. So let's build wealth. Let's stop consuming and let's start creating wealth. Money is not everything, okay? But I'm telling you, it helps you to live a better life, because when you go to bless people and you want to do things for others, you'll have the money to do it. Yep. Stop. So, hey, I appreciate that. Amen. I hit the wrong one. It's going so fast. All right. It's almost that time. I'm just going to be quiet. Hopefully we got 2 minutes and 35 seconds. I'm on a slight delay so I don't get in trouble. But this is what I'm telling you guys, that we need to change what we are doing. All right. Because you doing a dance? Go ahead, do your dance. If we change the way we see money, I'm telling you, I don't worry about money anymore. 2020, that died in 2019, to be honest with you. But 2020, I don't worry about not having money. I don't worry about that anymore. I don't worry about not having money, because I can tell you right now, for those of you that don't know, I was driving Uber as early as 2018, and I was investing all while I had my full-time job. Okay. And you said, yeah, you've been investing for over 25 years. Actually, I've been investing for over 27 years. Absolutely. But I'm telling you that this is what I did. So I could tell you, I didn't grow up with a silver spoon. 9 of us in a 1,100 square foot house. Okay. With 1 bathroom. So I'm telling you, if you change what you do, buckle down, You can build wealth. For those of you around the world, the American stock market is a way to make money. It takes a lot of wealth. He's not talking yet, so they're just nothing yet. So I'll chime in. So what I'm saying to you is going to profit you more than me just spitting out a bunch of stock. This is what's going to profit you. Okay? Change what you're doing. Just take an oath. When my refund check comes, I'm going to invest it all. I'm going to go and DoorDash, or I'm going to do hair, or I'm going to do whatever extra on top of my job. And not only am I going to do the $5 a day challenge, but I'm also going to trade. And watch what happens when you build wealth during a bear market. The great oracle, Warren Buffett, he said it, and I'm going to keep saying it. It doesn't take a lot of brains investing during a bear market. It just takes temperament. All right, here we go.
Stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. For the first question, we'll go to Chris Rugaber at the Associated Press.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement, it is not possible to predict with much confidence exactly what path for our policy rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate. The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
Thank you. Let's go to Nick Timros at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timros of the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then, apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales, or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, but and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time, and the economy is much stronger, and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate, we want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every 0.25 percentage point increase in your benchmark rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs. I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to arrive at a timing and a pace and composition and all those things, and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy. Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations. So that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year or hi, thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
Well, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. We have our eyes on the risks, particularly around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
If I could follow, just on a related question, the December SEPs had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason, the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek. Let's go to Gina. Okay, let's go to Steve Leisman.
Thank you, Mr. Bunton. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principles says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level, to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly and predictable. And so those are some of the ways I would think this lays out our, the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that, and we'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we actually haven't even really had the important discussions on a lot of the details that we will have at coming meetings.
Thank you. Let's go to Craig Torres.
Chair Powell. Chair Powell, good afternoon, Michelle and Chair Powell. Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing. Is Fed policy a risk, over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple of months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. And Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates. And I don't see why this is a matter for the Inspector General or anybody else I mean, why can't you give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks. A couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth, and that's sort of a downside risk from a growth standpoint. I would point to another risk is just further problems in the supply chains, which could slow down activity, and you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into more problems in supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information. We don't have that information at the board, and I asked the Inspector General to do an investigation, and that is out of my hands. I am playing no role in it. I seek to play no role in it, and I can't help you here today on this issue, and I'm sorry I can't.
Okay.
Thank you. We'll go to Gina now.
Thanks for taking our questions, Chair Powell, and sorry for my tech issues. I wonder if you could tell us a little bit about where your thinking on inflation stands today. The last time we saw an SEP back in September, we saw that you and your colleagues were projecting that inflation would sort of sink back down quite close to target by the end of the year. And I wonder if you still think that projection from December is a reasonable one, and if your thinking has changed at all, I wonder how you're thinking about that. And I also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So I'd say, since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse. I'd be inclined to raise my own estimate of 2022 core PCE inflation. Let's just go with that. By a few tenths today, but we're not writing down an SEP at this meeting. But I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern. So I think if you look at the FOMC participants, there's a range there, and that range has been moving to the right for a year now. And by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. If it deteriorates meaningfully further, either in the time dimension or in the size of the inflation dimension. So that's how we're thinking about it. As I mentioned, though, I think it's part of this will be that the Fed, moving away from a very highly accommodative policy to a substantially less accommodative policy, and then over time to a policy that's not accommodative in time. I don't know when that will be. Those are the things that we're thinking about. That's part of it. Another part of it is that fiscal policy provided an impulse to growth over the last 2 years. That impulse will be less. In fact, will be negative this year. And so that's another thing. The other one is we will eventually get relief on the supply side. And, the ports will be cleared up and there will be semiconductors and things like that. Now, what we're learning is it's just taking much longer. So I think longer than expected. And that, I think, does raise the risk that high inflation will be more persistent. I do think we'll come off of the highs that we saw in the early part of this episode in the spring last year. But really, the question is going to be what is inflation running at, and so we'll be watching that. And our objective is to get inflation back down to 2%. It's also to provide enough support to keep the labor market healthy. The labor market is very, very strong right now. And I think that strength will continue. There's really a shortage of workers. We see it particularly among production and non-supervisory workers and people in the lowest quartile. You see very large wage increases. I mentioned some of the other indicators. So I think that's what we're looking at. And we're also, we realize, I think, as everyone does, that this outlook is quite uncertain and that we're going to have to adapt. And we're going to communicate as clearly as we can, but we're going to have to be adaptable and, move as appropriate.
Great, thank you. Thank you. Let's go to Colby Smith.
Thank you, Michelle. Chair Powell, when you talk about being humble and nimble about the path forward for monetary policy, does that also include the possibility of raising interest rates by larger increments and, say, doing a 50 basis points hike at some point if inflation does not moderate sufficiently? And should we interpret this approach as a departure from the gradual pace that we saw during the last hiking cycle?
So, as I mentioned, we have not made these decisions. We really haven't. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate. And
I'll bring it back up, good people. This is where the Dow, NASDAQ, and S&P was when he first started talking.
And more persistently than we would like.
And
even in
this is where we are now. Look at the Dow, S&P, and NASDAQ. They are dropping.
Substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there is a pool of people out there who could come back into the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that.
Let's go to Rachel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's more a matter of, I think the problem that we're talking about here is really that people who are on fixed incomes who are living paycheck to paycheck. They're spending most or all of their of what they're earning on food, gasoline, rent, heating, things like that, basic necessities. And so inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of, inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really prone to suffer more. I mean, for people who are economically well off, inflation isn't good, it's bad. High inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more, so that's really how I think of it. And, we have to control inflation for the benefit of all Americans. But part of it is just that it's particularly hard on people with fixed incomes and low incomes who spend most of their income on necessities, which are experiencing high inflation now.
Thank you. Let's go to Edward Lawrence.
Thanks, Michelle, and thank you, Mr. Chairman, for taking the question here. So year over year, inflation's at a 40-year high. The input costs for producer price index for all of 2021 was the highest on record. Some investors fear that the Fed might be moving too late. Now, you said no decisions were made on the path of rate hikes, but was a rate hike more than 25 basis points discussed today? And as a follow to that, because I have problems with the mute button, as a follow to that, you testified that the supply chain issues could be worked out by the end of the year. You talked about that today. The CEO of Ford, though, told Fox Business today that the chip shortage will last into 2023. So today you said inflation will start to ease this year. I want to drill down and get a timeline that you see as to when we could see that relief. Thank you.
So I would not say that I would expect the supply chain issues to be completely worked out by the end of this year. I do not expect them, and I have not expected them. What I would say, and I have been saying, is that I expect progress to be made in the second half of this year, mainly. Progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up. But overall, we're not making progress.
Hey, good people. So I want to show you this, right? So this is Bitcoin. I'll bring them back up. This is Bitcoin. Look at Bitcoin, 37.8. Look at Ethereum, 26. Look at Solana, 100. This is when he started talking. And here's where it is now. See, 37, Ethereum 35, Solana 95. So crypto is going down also with the market.
Those decisions, we haven't made them. It isn't possible to sit down here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
Thank you. Let's go to Mike McKee.
Thank you, Mr. Chairman. I'd like to sort of weave some of the strands of your answers together and ask you, as you start to reverse policy, what your goal is. Are you going to be raising interest rates until you get inflation to 2%? Do you want to go below 2% so that on average you get a 2% inflation rate? And because you said we have to protect the employment part of your mandate, is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the the ultimate goal. And we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. What was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022. And that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. Ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also, high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals.
If I could follow up, does the danger of tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
State dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state-dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
Let's go to Michael Derby.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, that is what it is, but do you feel that monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
So I think it's too soon to write that history, really. But what I would say is this. If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down in large part, including our own economy, and people going to their homes for weeks on end in masks, and there are no vaccines, and it could be a really long time to get them, and then you have economic activity drops by a shocking amount in one quarter. So there was a real risk of lasting damage. And I think Congress responded remarkably with the CARES Act, incredibly timely, very powerful. There'll always be flaws in these things, but in real time, it was a remarkable achievement. And we responded, and what we were able to do was, stave off a collapse of the financial system at the beginning and make time for what really needed to happen, which was the income replacement and then the recovery that Congress enabled with the CARES Act. So now that was a lot. And what we did was a lot. And, what we have now is we have the strongest recovery of any any country, and we have a recovery that looks completely unlike other recoveries that we've had because we've put so much support behind the recovery, and we're managing the relatively high class problems that come with that, which are high inflation and a labor shortage. So, and these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5-year period, and we'll say, we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event, and I guess I'll have to leave it at that. I hope I'll be around to see how that looks in 25 years.
Fair enough. Thank you.
Thank you. Let's go to Jean Young.
Thanks, Michelle. Chair Powell, some investors are expecting the yield curve could flatten or even invert after rate hikes begin. Would that worry you? And how important is that risk in the Fed's consideration for adjusting policy?
So we do monitor the slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer-term interest rates, but it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, two-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. We don't think of it as, I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. But it's one of many things that we monitor.
Can I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Thank you. Let's go to Brian Chung for the last question.
Chairman Powell, Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly, within the context of hiking cycles, it's often the talking point for financial stability and wanting to make sure that asset bubbles don't merge. Is that something that has also factored into the conversation as you start to think about hiking rates? Thanks.
I would describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It's going to involve, and it does involve, finishing asset purchases. It's going to involve lifting off. And it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off and do so in a predictable manner. And that's something that we will also be doing as appropriate. And I wouldn't, I don't think it's possible to say exactly how this is going to go, and we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much stronger than it was, and growth is above trend even this year, let alone last year. So All of those things are going to go into our thinking as we make monetary policy. And you asked about financials to have concerns in connection with our policy. Was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We of course have a financial stability framework, and what it shows is a number of positive aspects of financial stability. But you mentioned really asset prices is one of the four. So asset prices are somewhat elevated, and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector around money market funds, although the SEC is has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable. I would say.
Thank you very much.
Thank you.
That was the end.
That was it, good people. I needed 3 more hands. Had the calculator out. I was trying to show you guys what the Dow, S&P, and NASDAQ was doing in real time. Can you guys hear me? So I was trying to show you guys everything that was happening in real time. Look at this. Look at the Dow now from when it started. It's crazy. Hold on, let's see.
Dow, which is really what we've seen in the last few days. The interpretation of what Fed Chair Jay Powell said, as you mentioned, was hawkish. He did not rule out a 50 basis point or a double interest rate hike. He did not rule out hiking at every single meeting. He said that they hadn't made those decisions yet, but he didn't rule them out. And he did talk about the fact that we are in a very different place than we have been. A higher, stronger growth economy, faster inflation than what was expected, and a lot of accommodation out there. He also talked a lot about the balance sheet, which of course the market was very interested in, said that they're not there yet in terms of the decision. It's going to happen in terms of shrinking the balance sheet after they raise interest rates, and it could take a few more meetings to talk about, but that is also going to be a huge focus for investors. I'm watching the dollar spiking along with especially short-term treasury years, the 2-year note yield at multi-year highs. We've got a lot to talk about. Stocks going in the red and looking at session lows as we speak. We've got a great show coming your way. We are going to talk with a number of market experts, thought leaders, Liz Ann Saunders from Charles Schwab, Mohamed El-Arian from Allianz, Galaxy.
Sorry about that, good people. I'm talking and this wasn't on. So yeah, it's time to dollar cost average in. So I was saying in 2008, when we were here again, when the banks screwed us over, I literally was in front of my computer. I was upstairs in my office and I bought Citibank. I bought Citibank at like $4 and something. Like it was like $4.98. All right. Citibank is now $64. I have had some shares since 2008. So I also went to show you guys that are just into crypto that, listen, you got to know what's going on in the stock market to make money in crypto, because crypto will not, from here on out, crypto will not escape the stock market. So if you know the stock market, if you see what's happening, you can kind of trend what's going on with crypto. And somebody said, these guys, these YouTubers, number one, I'm not a YouTuber. But anyway, I hate that term. But anyway, I guarantee you I'm going to make more money than some kid that just bought Dogecoin last year and made some money. It was easy. Anybody that bought Dogecoin in 2020 or 2019, you're up. So this is why I want to help you guys really make money and make some smart decisions. I will tell you that there is a ton of money to be made. There is absolutely a ton of money to be made. As low as these stocks go down, can you guys hear me? I thought I unmuted it. No sound. Can you guys hear me? Hopefully I unmuted it. I see it registering. So this is what I want you guys. Let me know if the audio is good. Somebody let me know by saying I can hear you. Thank you. So this is what's happening in this game, good people. They got more breaking news. Oh, same stuff. So this is how we know how to play this game. You could do what you want to do, but now I am going to start dollar cost averaging in the $5 a day challenge. Now, my big powder, my dry powder, the chunks of money that I'm going to throw in to buy big dips, I'm not going to do that just yet because he just told you. Now, I'm going to tell you something about March 16th. The market will price some of this in, okay? Just like today. Jerome Powell said, for those of you that didn't get the Gina joke, this was from Martin. Jerome was the guy and everybody was talking about Gina, Martin Lawrence. But anyway, it was funny. But listen, we got to understand what's coming now. So don't look at your portfolios right now. We got to look at what's coming. We know the interest rate hikes are coming, right? But Jerome Powell literally just got in front of us and said what he's been saying. He literally just said what the notes have been saying. But what does the market don't like? The market does not like uncertainty. Okay? So he said, we're going to wait till March. And some might ask, why don't he do it now? That's a good question. Just do it now and get it over with. Okay? But now that we know that the market is going to be fluctuating from now until then we can start dollar cost averaging. All right? Am I muted again? What's going on with my sound? This could be my computer, good people. I'm sorry. I got a brand new computer. Let me get this fixed because this is important. Can you hear me on your phone?
No.
I don't.
They can't hear you.
Huh? I don't know what's going on. I got it. I'm unmuted. Let me try this again. We can hear you just fine. Oh, okay. All right. Thank you, good people. I'm just trying to, I don't know. It's saying we can't hear you. Can you get your volume up? Turn your volume up and let me know. Okay, we can hear you. Thank you, good people. So all we got to do right now, so please help me in this page. My $5 a day challenge, I am going to start it. But now, the money that I have from January 1st to now, I'm going to hold that. And I'm going to start $5 a day in right now, okay? But the money that the other $5 a day per stock, When I see the next dip, that's when I'm going to put that all in. And then I'm just going to continue to $5 a day right now. The Dow is down 68% from its highs. That's why. No one knows where the bottom is. That's why. The market will price in some of the fears of March 16th. That's why. So that's why I'm going to start dollar cost averaging in, right? But remember, it's $5 a day. But that has nothing to do with my big investment, like the monies that I'm going to put in and dump into stock that I think are at a good value. Okay. And so remember, I got two portfolios, and sometimes there's the same stock in both, meaning I could DCA into QQQ, right? But I can also buy a big chunk of QQQ. That's why for those of you that are dollar cost averaging, it's good. I use Fidelity for my dollar cost averaging because it's so easy and simple to buy fractional shares. But when I'm swinging it, I do that in my Webull. And people say, why do you use Webull? Because most of these earning calls are after the closing bell. I could get on Webull and start trading up 4 hours after the bell closes. That's why, because I make more money before the market opens and after it closes, to be honest with you guys. So that's why I want you guys. I got the link for Webull below. I say Fidelity. And for those of you that have other legacy brokers, leave comments. If you got other legacy brokers that is easy to $5 a day, just post it in the comments so we can help the rest of the family, okay? But for all of you guys that are want to just take advantage of this opportunity to get stocks and crypto at a low price, and you don't know where the bottom is, dollar cost average, okay? And do like this gentleman does, all right? Do like this gentleman did. I'm telling you guys right now, if you want to change your life, do this. I started driving Uber, part-time gig, okay? So that's what I like. Do something different. Do something you good at that you can make money, and in that way, and I want you to invest this whole year. Just roll with the family for 1 year. This is not going to help me. It's going to help you. I'm not making one dime off of this. I challenge you every time you save a dime this year. If you go to a restaurant and they give you 50% off, invest it. If you get a tax return check and you don't need it to pay your bills, invest it all. And I don't care if you dollar cost average with it. This is the time to start buying into the market when it's oversold. So now, I'm going to end, but I want to be clear. My $5 a day, I am going to start dollar cost averaging in now, right? I'm not buying any big dips right now with my other money. The big dip buying, I'm going to wait to probably closer to March 16th, okay? Because I just want the fear over. And I don't need to buy at the absolute bottom. We don't know where it is. We don't know where the bottom is. And so, and I just want you guys to just think about this. By the end of 2025, I guarantee you some of the stock that we're going to, and crypto that we're going to be investing in, some of the stock will be up 300% by the end of 2025. Some of the crypto will be up 500 to 700% by the end of 2025. I'm telling you this. And so listen, if you come back to this video and it's only up 400% and you was promised 700%, man, please, you still doing good. So now is the time, family, for us to get down, get busy, work, invest, tell your sons, your daughters, tell Gina, Martin, them, tell everybody, for all you guys across the world, the greatest transfer of wealth is happening right now. All right. All right, good people. I'm going to leave it right there. I just tried to do everything I can. I'm proud of myself. I flew the ship again by myself. And I love each and every one of you guys. We are going to get what's rightfully ours. And I'm telling you right now, when they bailed out these banks, your mothers and your fathers' 401ks that they took all of this money from, this is our money. We're getting what's rightfully ours. Okay? I love each and every one of you from all around the world. I'm going to sign off right here. I'm going to try to play my, man, what is the other outro? What is I guess it's the intro. I don't know what it is. Oh yeah, I'm gonna play my other outro from my other show. I want you guys to make sure you check out all the links below. And for those of you that are don't have the ability to trade before the market opens and after it closes, download the Webull link below. I have the link below. Download it, deposit $1, and they're going to give you 3 stock worth up to $3,300. Okay, good people. We just going to leave with this jam. All right, good people. All right. Nope, that's not it. What happened to it? There we go. Love you guys. Live, love, laugh, and learn.
What's up, good people?